Hey everybody, welcome to Things You Should Know, College Counting Edition. Today we're going to introduce you to our next section, accounting for sales, cash receipting, and handling accounts receivable. When handling sales of any sort, you'll need to determine what kind of sales that the company is handling. The three most common business types are manufacturing businesses. It's someone who creates and then sells goods such as flying widgets. We all love flying widgets. Service businesses, someone who sells their services such as a massage therapist selling a massage. A retailer, a merchant or retailer of goods. Basically a grocery store would be a retailing business, acting as a middleman by selling grocery items that they buy from a distributor to you at a slightly increased price. All three of these companies need to be treated slightly differently. We'll focus on these differences and explain the different general ledger accounts used. The largest focus will be on retailing, as these are the most common and most varied types of businesses and accounts. In the next few videos, we'll handle recording transactions of selling goods, recording making money off selling goods, and in the videos after that, we'll handle transactions of buying those goods from distributors. All businesses utilize what is called a distribution channel. A simple distribution channel provides the product from the manufacturer, who then sells it to a wholesaler, often called a distributor, who then sells it to a retailer, who then finally sells it to you, the consumer. At some point in the future, we may have a video detailing why a supply chain looks like this, but for now, we'll focus on the retailer portion of the chain. Up until now, Jello's been running his coffee shop. However, he has discovered that people love cups, coffee, and other swag he sells. In fact, not only does he sell to individuals, but other coffee shops and even corporations have started to buy the swag in larger and larger amounts. By the end of his first year of his coffee shop, he's doing enough business he decides to open a second store. This one focusing on selling everything about coffee, including maybe even a cup of coffee itself. He names his new store Jello's Coffee Plus. Jello's Coffee Plus must account for the sales of goods utilizing different forms of purchases and must maintain a merchandising inventory, the stock of items that Jello will sell to the public. We'll be utilizing some new accounts that we'll need to add to our chart of accounts. There are 5 accounts. The first one is sales. It's a revenue type account that normally carries a credit balance, and it records sales of retail inventory, such as selling a cup or a shirt or something to a customer. Sales tax payable. This is a liability. It is also a credit account. It's sales tax charged to the customers. After all, Big Brother always needs his portion. Sales discounts. This is called a contra revenue account, and we will cover those more later, specifically on what a contra revenue account is. Sales returns and allowances is another contra revenue account. It normally has a debit balance, and it's products that are returned by the buyers on the Jello's books, such as somebody didn't like that coffee mug, maybe there's a chip, or maybe Jello, you just shouldn't buy pink shirts, only your husband loves pink shirts. The final account we're going to add is the credit card expense account. It has a normal debit balance, and it is the fees charged by credit card companies to Jello. Since we've already introduced new information today, we'll only do a single example. In this example, we'll handle the recording of sales for cash on account. The sales account is the primary account used by revenue for Jello's Coffee Plus. Take, for example, the following journal entry for a sale of $200 worth of swag on January 9th. See before here, we have the good old general journal entry. This time it's page 3. Oh, he must be doing some sales. January 9th, 2015, he received cash in the amount of $200 for the swag. He records it to sales, $200 to sales. Make sure always to remember to notate what it was for, and this was just to record cash sales. So, this second example, you once again note it's dated January 9th. This is an accounts receivable. Basically, Ditzy Ladybug, if we notice here, bought some items and was issued sales slip 1001. The condition was Ditzy didn't have any cash on them, so they bought it on accounts receivable, which basically means Jello opened an account that they could charge Ditzy Ladybug for any purchases now, and Ditzy will pay back later. In this case, you'll see accounts receivable, bought $500 worth of stuff, and will always credit sales. Remember, sales will always get credited. On February 1st, Ditzy Ladybug paid for its supplies. If you'll notice, they brought in cash for $500. Like all sales transactions, we'll record the cash it receives as a debit. Now, this isn't an actual sales. This is payment for what was owed. So what we'll do is we'll credit accounts receivable. Basically, this will move $500 off the accounts receivable. You'll have it added there, removed here, and instead we add the $500 cash. Remember, to always mark what it's for. And here you can see I said it's received from Ditzy Ladybug for sales slip 1001 to pay off outstanding account. Well, folks, that's it. That's our quick new introduction to our accounts receivable. It's our new introduction to a whole bunch of stuff, actually. Join us next time for more examples for such things as handling the recording of sales tax payables, sales returns, and sales allowances. God, isn't it being an accountant awesome?